So we all understand that QE, the printing of money, the easing, the injection in liquidity, the inflow of stimulus to consumers out there and households, and most importantly, rate cuts, all contributed to higher inflation, with also supply chain constraints that also fueled up higher prices. Now, what about the argument of higher interest rates? Because higher interest rates are being conducted by the central banks to tame inflation. But if you look at the inflation numbers and you look at just the recent number of Fed's favorite inflation number, the PCE number that came out on Friday, if you look at that, that also came in hotter than expected. And inflation seems to be sticky and staying where it is as of right now, according to the data. Not saying that it can't come down lower down the road, and not saying that, it can't go higher. It definitely can, has a possibility of that as well. But I thought inflation was supposed to come, or the Federal Reserve and many of the central banks thought that inflation would come down quicker than they expected. And the way to solve that is continue to hike rates. And that hiking rates is supposed to put a lid on higher prices. But we're still not seeing prices come down. Now, don't get me wrong. We did see the inflation levels peak last year, and it has come down quite a bit, but not to levels of pre-COVID levels. Are we ever going to get there? What is going on? And why is this higher interest rates that we're seeing is not putting that lid on that inflation? What is going on here? Now, before I start, my name is Daniel. I run an organization called Infovest. Infovest is an organization that promotes financial literacy, teaches you about the economics, the macroeconomics. We've got courses that ties in economics to the financial markets, teaching you about stocks, bonds, commodities, currencies, and crypto. If you're interested in that, just check out the website, infovesting.com. The link is in the description if you would like to learn more. Now, let's get into this. Now, interest rates, as we've been seeing, and yields, right, on the bond yields that we're seeing and the mortgage rates that you've also been watching, have all been climbing, especially since last year, and continue to rise as well, especially with new comments that we're hearing from certain members, certain Fed members, more hawkish than others. Some on the fence that, hey, we shouldn't pause, we shouldn't cut, we should continue to hike and hike and hike. One Fed member, Bullard, said, we could go, as far as even close to 6%, which I did a video on many months back, that 6% interest rates is not so crazy to think of, especially if inflation is not coming down. But what about the argument, if I were to make here right now, saying that interest rates is actually a cause of higher inflation, right? Your yield, the yield on the bond yield, your mortgage rates that are climbing is contributing to also inflation. Now, how so, right? How can you say that, Daniel? You're completely wrong. It's supposed to bring down inflation. Yeah, according to theory. Don't get me wrong there. If you look back in history, 1980s, and you look back in previous levels as well, in previous crashes, when you have the rates above the inflation level, you tend to see inflation come down, and also at the same time you tend to see a recession, of a hard landing that also contributes to the prices coming down. Now, in 1980s, in order to get the inflation level down, you had to keep rates above the inflation level for some time. And we finally got that. We just got the rates above the inflation level just recently, as they hiked just recently this year to the 5+% level, right? So we finally got that. The question is, how long does the rates have to stay above the inflation level in order to get inflation to come down even further? But what about the argument of that rates, the fact that rates are going up, it's keeping inflation elevated? How so? Well, look at the shelter component, right? The housing prices out there, right? When you look at also the housing numbers, the index out there, right? Let's first start with couple of data points. When you look at, for example, sales number of houses being sold, that has gone up last month. When you look at also when it comes to the prices, there's been a slight rebound also during the summer months. When you look at the shelter, like for example, rent and so on, and the cost of living and cost to put shelter, a roof over your head, also have seen an increase. And even as they have dipped from the peak of 2022, it's still at elevated levels. Shelter is still very sticky. So what's going on? Again, I thought interest rates were supposed to bring prices down, but we're not seeing that. Well, let me put it simply here. If the rates are going up, your bond yields are going up, and you come back and you see that, hey, I need to renew my mortgage, and or you're out getting a mortgage, and if you especially have a variable rate, and let's say the bank, which they do with many clients, send out these renewable rates, and you get that mail to, in the inbox saying that, hey, you're up for renewal. This is your new payment now because rates have gone up. That's a contributing factor to inflation, right? You're now paying more for shelter. So now you're paying more for shelter. Yes, that is contributing to the CPI, which calculates shelter prices there. And that's why it's staying sticky, because you're paying more in the mortgage, right? So this phenomenon, if this continues to happen and rates continue to happen, how do you get shelter prices to come down, especially when inventory is tight and rates continue to go up? So in fact, if the Fed, like for example, Fed Bullard comes out and says we need to raise rates to 6%, or continue hiking rates, and Mester and all the other Fed members saying that we need to fight inflation and we need to combat it with higher rates, you might actually be contributing to the problem there by hiking people's mortgage rates and causing the prices to go up. Now, also, for example, a landlord, right, who rents out their homes, and they get that in the mail that, hey, it's time to renew your mortgage. And now the landlord who owns a couple of homes, couple of properties, sees that, okay, the cost is going to go up. What do? They pass on that cost to the person who's renting. They will increase their rent. The rent prices will go up. That also is a contributing factor to higher prices. Now, until what point will the inflation come down? Right? So if this is contributing, and we look at past history, that according to the Taylor rule, higher rates above the inflation level is supposed to bring inflation down, and you look at past history, 1980s, 2000, 2008, recent COVID crash, etc., look back in history, the rates above the inflation level, that eventually causes the inflation to come down. It may not, sure, you may say Taylor rule may contribute to that idea, but it's really the recession, the hard landing, the demand crunch, the crash that completely brings prices down, right? So it's that recessionary environment that's bringing that prices down. Right? So the Taylor rule that's keeping prices, interest rates higher and above the price level, if there's no recession, there's no really big crash, hard landing, then guess what? You can keep the Taylor rule for as long as you can, for 6 months, 7 months, 8 months. If nothing breaks and the economy is doing fine, then guess what's going to happen? A reaction from the central bank saying, hey, let's hike rates now. Let's hike rates again. And okay, you're hiking rates, And if your mortgage is coming for renewal, then you're going to be paying more, and you're going to be paying more for shelter. It's going to definitely hit you. Definitely is going to change your spending habits. Definitely you're going to be shopping very, very differently. You're not going to buy those iPhones and whatnot, which those businesses are going to be massively hit, which leads me into one direction, which makes me think that just like Jerome Powell said in August of last year, the unfortunate consequences, the unfortunate cost of bringing inflation down is there's going to have to be pain for businesses and consumers. So that may mean that maybe there might have to be some panic selling in the economy, in the markets, maybe an inflow of inventory on the market because people need to get out of their houses. Or forget about the housing, let's talk about just the stock market itself, that there needs to be this panic of getting rid of assets, selling them off, because maybe you've lost your job, the unemployment rate skyrocketed, you can't pay for that that mortgage anymore, you got to downsize, whatever the case may be, you got to sell assets to pay off certain loans, you need that money because you've lost the job and you need to pay for current expenses. It's that scenario there that may cause inflation to come down, and that's where maybe the 2% target that the Fed wants to aim for and hit may be achieved. And in order to achieve that, you need that ugly recession, that ugly crash. Otherwise, higher for longer, tighter for longer, higher rates, more tightening in the markets, which is going to cause a lot of pain, just like Jerome Powell said in August of last year. And that may be the only solution, especially as rates continue to go up and we're still not seeing inflation levels to come down. And as we heard from the Fed members, they have said that the inflation is staying and sticking around more longer than they anticipated, which is a problem, which sounds very hawkish, which also means that, hey, they want to see pain. They want to see people losing their jobs. They want to see a complete crumble in the economy. They're just not saying it to you black and white the way I'm saying it on this video. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.